The end of the dollar era, why central banks are in a gold-buying frenzy. Have you ever considered what holds the global financial system together? For decades, the answer has been the United States dollar. But what if that foundation is cracking? What if the very nations that once propped up the dollar are now systematically, quietly, and relentlessly moving away from it? This isn't a theoretical exercise. It's a seismic shift happening right now, evidenced by one of the most ancient and reliable barometers of economic fear and instability: gold. We are witnessing a flight to safety on an unprecedented scale, a silent monetary revolution that could redefine wealth for a generation. The indicators are flashing, and they point to a future where the dollar's dominance is no longer guaranteed. The core of the problem lies in the inherent trust required to maintain a global reserve currency. For over 50 years, the world has operated on a system of faith in the U.S. dollar, a fiat currency backed by nothing more than the full faith and credit of the United States government. However, this faith is eroding. The primary accelerant of this decay has been the increasing weaponization of the dollar. When the United States uses its currency as a tool of foreign policy, imposing sanctions and freezing assets, it sends a powerful and chilling message to every other nation: your dollar reserves are not truly yours. They exist only at the permission of Washington, D.C., creating a profound and urgent incentive to find an alternative. This search for a neutral, non-political store of value has led nations back to the one asset that has outlasted every empire and every currency in history: gold. The problem is simple, yet existential for countries seeking monetary sovereignty. If your nation's wealth can be turned off with the flip of a switch in a foreign capital, you are not economically independent. This realization isn't new, but its urgency has reached a fever pitch. Countries are no longer just considering diversification. They are actively and aggressively executing it. This isn't merely about hedging against inflation. It's a strategic geopolitical maneuver to de-risk from a unipolar financial world and reclaim national economic security. To truly grasp the magnitude of our current situation, we must rewind the clock to the post-World War II era. The Bretton Woods Agreement, established in 1944, pegged global currencies to the U.S. dollar, which was, in turn, convertible to gold at a fixed rate of $35 per ounce. In the 1950s, the United States was the undisputed economic hegemon, holding approximately 20,000 tons of gold, nearly all the official above-ground reserves in the world. This gold backing gave the dollar its legitimacy and stability. It was the anchor of the global financial system, a promise of tangible value that underpinned international trade and prosperity for a quarter century. However, the seeds of the system's demise were sown by its own success. As America's trading partners, particularly in Europe and Japan, rebuilt their economies, they began running massive trade surpluses with the United States. They accumulated vast quantities of dollars, and, as was their right under the Bretton Woods system, they began exchanging those dollars for physical gold. The outflow was relentless. Nations like France and Italy each repatriated 2,500 tons, Germany accumulated over 3,000 tons, and Japan and the UK also redeemed their dollar holdings. By 1970 U.S., gold reserves had plummeted from 20,000 tons to just 9,000. The promise of the dollar was being called in, and Fort Knox was emptying. The situation reached a dramatic climax in the early 1970s. The run on American gold reserves was becoming a stampede. In a move of profound geopolitical significance, the French government dispatched a naval vessel to New York Harbor with a clear mission: to pick up its gold and transport it back to Paris under military escort. This was more than a financial transaction. It was a clear vote of no confidence in America's ability to manage the global monetary system and honor its commitments. The message was unmistakable. The era of unquestioned American economic dominance was over, and the very foundation of the Bretton Woods system was about to shatter. On a fateful weekend in August 1971, President Richard Nixon convened a secret meeting at Camp David with his top economic advisors, including future Federal Reserve Chairman Paul Volcker. Faced with dwindling gold reserves and mounting redemption requests, the administration made a pivotal decision. Nixon went on national television and announced the temporary suspension of the dollar's convertibility into gold. This act, now known as the Nixon shock, effectively closed the gold window and unilaterally dismantled the Bretton Woods system. The move was intended to be a stopgap, a way to force a renegotiation of currency values and restore order. It was meant to be temporary, but it became permanent. In the immediate aftermath, there was a frantic attempt to salvage the fixed exchange rate system. The Smithsonian Agreement in December 1971 saw the dollar devalued against gold, with the official price rising first to $38 and later to $42 per ounce. The dollar was also devalued against other major currencies like the Japanese yen and the German Deutschmark. The goal was to re-establish a modified version of the Bretton Woods framework. However, the trust had been broken. Germany, weary of the instability and the burden of defending the dollar's peg, decided to let its currency float freely, allowing its value to be determined by market forces. This was the final nail in the coffin, and the world has lived with a system of floating exchange rates ever since. The collapse of the gold standard ushered in a new era for central banking. For the next 4 decades, from the 1970s until around 2010, central banks globally became net sellers of gold. The United States itself led the way, selling another 1,000 tons in the 1970s, reducing its holdings to the peculiar and specific number of 8,133 tons, where it has remained ever since. This period was characterized by a concerted effort, particularly from Western nations, to demonetize gold and elevate the U.S. dollar as the sole pillar of the international system. The message was clear: gold was a relic and the future belonged to fiat currencies. The selling was widespread and often ill-timed, reflecting the prevailing anti-gold sentiment. The International Monetary Fund sold over 1,000 tons of its reserves. In a now infamous move, the United Kingdom, under Chancellor Gordon Brown, sold half of its gold reserves between 1999 and 2002 at an average price near $250 an ounce, hitting the 20-year bottom of the market. The event was so poorly managed it was dubbed Brown's Bottom. Switzerland followed suit, selling over 1,000 tons in the early 2000s, a decision that proved so unpopular with its citizens that it later prompted a national referendum to halt any further sales. These actions reinforced the narrative that gold's monetary role was over. The inflection point, the catalyst for the modern gold rush, arrived in the wake of the 2008 global financial crisis. The collapse of Lehman Brothers and the ensuing chaos sent a shockwave through the international community. It exposed deep vulnerabilities within the Western-centric, dollar-denominated financial system. For non-Western central banks, particularly those in China and Russia, the crisis was a stark warning. It demonstrated that their vast holdings of U.S. Treasury bonds were not just financial assets, but potential points of leverage that could be used against them. The need for a true safe haven asset, one outside the political control of any single nation, became glaringly apparent. Around 2010, the decades-long trend of central bank gold selling abruptly stopped and then dramatically reversed. The sellers were replaced by a new class of powerful buyers. These were not the traditional Western powers, but the rising economic forces of the East. The central banks of China, Russia, Turkey, Kazakhstan, and India began a systematic and sustained program of gold accumulation. This wasn't a speculative bet. It was a long-term strategic shift in reserve management. They were quietly building a foundation for a new monetary reality, one less dependent on the whims of the U.S. Federal Reserve and the U.S. Treasury Department. This shift from net selling to net buying by the world's most powerful financial institutions marks the critical tipping point. It established a new dynamic in the gold market. Ever since 2010, central banks have been consistent net buyers, absorbing a significant portion of annual global gold production. This steady price-insensitive demand acts as a powerful support mechanism for the gold price. These institutions aren't day traders. They are accumulating strategic reserves for the long haul. They tend to be smart buyers, often increasing their purchases on price dips, which helps to establish a solid floor under the market and changes the entire risk profile for gold investors. This brings us to the immense opportunity presented by what can be described as an asymmetric trade. On one hand, you have a limited downside. The persistent buying from central banks creates a soft but reliable floor. They are not looking to spook the market. Their purchases are methodical, often executed through standing orders with large bullion banks. This creates a buffer against severe price collapses. While no investment is without risk, the presence of such large, stable buyers fundamentally mitigates the potential for a catastrophic drop. The downside is cushioned by the very entities that control the world's money supply, providing a unique safety net. On the other hand, the upside potential is virtually unlimited. The same factors driving central banks to buy gold are also influencing sophisticated investors and eventually the general public. The fear of dollar weaponization, concerns about sovereign debt levels, and persistent inflation are not going away. These are long-term structural issues that will continue to fuel demand for a store of value that cannot be debased. As this demand grows against a relatively fixed supply, the potential for significant price appreciation is enormous. This combination of limited downside and unlimited upside is the textbook definition of an asymmetric trade, a rare and highly sought-after investment setup. The impact of this shift is now clearly visible in the market's fundamentals. The laws of supply and demand are reasserting themselves with force. For the past several years, the global supply of gold from mining and recycling has been remarkably flat, hovering around 4,000 tons annually. Despite rising prices, new major gold discoveries are rare, and bringing a new mine into production is an arduous, decade-long process fraught with regulatory and environmental hurdles. We are likely at or near peak gold, meaning that the annual new supply is unlikely to increase significantly regardless of the price. While supply remains constrained, demand is unequivocally on the rise. We have already detailed the primary driver, strategic accumulation by central banks. But this is augmented by growing investment demand from institutions and individuals who share the same concerns about currency debasement and geopolitical risk. When you have a dynamic of flat or stagnant supply met with steadily increasing demand, the economic outcome is inevitable. The price must rise to balance the market. This isn't complex financial engineering. It is the most basic principle of economics at play on a global scale, creating a powerful tailwind for the price of gold. Critically, we are still in the early stages of this secular bull market. What we have not yet seen is the final explosive phase driven by a retail frenzy. The current price appreciation has been driven by smart money, central banks, and sophisticated investors. The average person, the retail investor, has largely been a spectator. This stands in stark contrast to the mania of January 1980, when there were lines around the block at coin shops and gold dominated the headlines. Today, the sentiment is one of quiet accumulation, not public euphoria. This suggests that the most significant part of the move is still ahead of us. The psychological phenomenon of anchoring will play a crucial role in the next phase of this market. People tend to anchor on round numbers, like a $1,000 increase in the price of gold. When gold moves from $2,000 to $3,000 an ounce, that is a 50% gain, a very substantial and noticeable move. However, the next $1,000 move, from $3,000 to $4,000, is only a 33% gain. Subsequently, moving from $4,000 to $5,000 is just a 25% increase. Each successive $1,000 milestone represents a smaller percentage gain, making it psychologically and mathematically easier to achieve as the price climbs. This psychological dynamic is what fuels the final parabolic stage of a bull market. By the time gold moves from $9,000 to $10,000 an ounce, that $1,000 jump is only an 11% move. A gain of that magnitude could happen in a single month or even a week during a period of high volatility. It is at these higher nominal levels that the retail investor, who has been watching from the sidelines, finally wakes up. The fear of missing out becomes overwhelming. Headlines about gold reaching $8,000, $9,000, and $10,000 will create a feedback loop, drawing in waves of new buyers. This is the frenzy stage, where prices can detach from fundamentals and reach seemingly impossible levels, potentially pushing toward $20,000 an ounce or higher. The aftermath of this monumental shift will extend far beyond the price of precious metals. It signifies a profound reordering of the global financial landscape. The move towards gold is a symptom of a larger trend: the gradual decline of a unipolar, dollar-centric world and the rise of a multipolar system where economic power is more widely distributed. Gold's reemergence as a premier reserve asset is a return to a neutral, apolitical foundation for money, a direct challenge to the exorbitant privilege the United States has enjoyed for nearly a century. This transition will likely be volatile, but it is a necessary correction in a system that has become dangerously imbalanced. This same search for tangible, inflation-resistant assets is also reshaping other critical markets, most notably residential real estate. A new and powerful force has entered the housing market: large-scale institutional investors. Historically, individual families buying homes with mortgages were the primary drivers of this market. Their decisions were based on affordability, which was heavily influenced by the monthly mortgage payment. Lower interest rates meant lower payments, which stimulated demand and pushed prices higher. This relationship was predictable and formed the basis of the housing cycle for generations of Americans. However, a strange and unprecedented phenomenon is disrupting this traditional cycle. Large institutional players such as private equity firms and asset managers are now buying up tens of thousands of single-family homes, not for development or resale, but to hold them as rental properties. Their objective is not to flip the house for a quick profit, but to convert it into a long-term, income-generating asset. They are fundamentally transforming real estate from a component of the American dream into a financial instrument, akin to a bond. The goal is to invest a principal amount and generate a predictable stream of cash flow from rental payments indefinitely. This institutional buying spree has a pernicious effect on the housing market's supply and demand dynamics. When tens of thousands of homes are purchased with no intention of ever being sold back to individual homebuyers, they are effectively removed from the for-sale market forever. This creates an artificial scarcity of available housing stock. So even if lower interest rates make mortgages more affordable on paper, the lack of available homes for sale means that affordability in the real world plummets. Aspiring homeowners are forced to compete for a shrinking pool of properties, bidding prices up to unsustainable levels, while a growing portion of the housing stock is controlled by corporate landlords. The impact is a structural shift in the very nature of homeownership. The market becomes less accessible to the average family, who must now compete with all-cash offers from multi-billion-dollar corporations. This can create a permanent renter class, a modern form of debt peonage where the dream of building equity through homeownership is replaced by the reality of perpetual monthly payments to a faceless financial entity. This trend, much like the central bank gold rush, is a direct consequence of a world awash in cheap money searching for a home in scarce, tangible assets. It is another sign of a system under immense stress, where financialization is consuming the real economy. The lesson from these parallel trends in gold and housing is clear and urgent. We are in the midst of a historic flight to hard assets. The debasement of fiat currencies and the erosion of trust in traditional financial institutions are forcing capital, both sovereign and private, to seek refuge in things that are real and finite. Gold cannot be printed by a central bank, and the supply of desirable residential real estate is inherently limited. This scramble for tangible value is a rational response to decades of fiscal irresponsibility and monetary excess. It is a defensive maneuver against a system whose foundational promises are no longer credible. The long-term implications of this transition are profound for individual investors and savers. The strategies that worked during the era of dollar hegemony and disinflation may prove disastrous in the new paradigm. Holding wealth in traditional cash savings or government bonds becomes an exercise in guaranteed loss of purchasing power. The takeaway is the urgent need to reconsider the nature of true wealth. In an environment of systemic instability, ownership of tangible assets that exist outside the traditional banking and currency system becomes paramount. This isn't about market timing or speculation. It is about wealth preservation in the face of a fundamental regime change in the global monetary order. Furthermore, the increasing financialization of essential goods like housing poses significant societal challenges. When a basic human need is transformed into a speculative financial asset class traded by Wall Street, the social contract begins to fray. The disconnect between rising asset prices and the stagnant wages of the average citizen becomes a source of social and political instability. The same forces driving the price of gold to record highs are also making the dream of homeownership unattainable for millions. This creates a two-tiered system of asset owners and asset renters, exacerbating wealth inequality and fueling populist discontent. The ultimate aftermath of this great rebalancing is yet to be written, but the direction of travel is becoming clearer. The world is moving away from a single dominant reserve currency and toward a more fragmented system where gold will likely play a more central and official role as a neutral settlement asset. For individuals, this means that the value of their savings and their financial futures will be increasingly tied to their ability to navigate this transition. Ignoring the warning signs embedded in the price of gold and the changing structure of the housing market would be a perilous mistake. The game is changing and the old rules no longer apply. Therefore, the enduring lesson is one of prudence and a return to first principles. For centuries, gold has served as the ultimate form of financial insurance, a hedge against the inevitable failures of human-led monetary experiments. Its current resurgence is not a prediction of doom, but a rational market signal that the current experiment with purely fiat currencies is under severe strain. The actions of central banks and large institutional investors provide a clear roadmap. They are preparing for a future with greater financial uncertainty by anchoring their wealth in tangible, enduring value. The question every individual must ask is whether their own financial house is built on a similarly solid foundation.